Well, good morning. It's Damian from the Peak Partnership. Normally at this time of the year, we'd be going into the Peak Partnership Budget Breakfast, as announced by Scott Morrison. Due to COVID, we've had to put that on hold. So what we thought we'd do is a video presentation. The positives for you are that you're able to pause, fast forward across the interesting bits, or even review some of the information we're about to give you. So please, grab a coffee and watch this at your leisure. We hope it's informative. Well, let's get into a bit of detail for the 2021-22 federal budget. Firstly, the legal stuff. Just be reminded this is just general commentary on the budget issues and what's possible. It's not to be considered personal advice. You should actually engage with a qualified professional like us here at the Peak Partnership to get your personal advice. So the 22 budget at a glance. What's it all about? Firstly, we have to say it's a big spending budget. It's one of the biggest spending budgets we've seen since the GFC, and it's on the back of obviously the JobKeeper type payments that we've had through COVID-19. The government is focusing on lowering unemployment, and they wanted a sub 5% level there, on the assumption that people in work spend money, and they obviously contribute towards the taxation net as well, and they're not on the job seeker program while they're doing that. There is no COVID recovery levy in the budget at this point in time. We have seen these levies introduced in the past where we had a flood levy and also a deficit levy which added 1 or 2% onto the tax rate, but there's nothing there at this point in time. And this will be one of the largest deficits in our history. We will max out in 2024-25 at almost $1 trillion. That's with a T, trillion dollars worth of deficit. The big picture. Let's have a look at the deficit and how it builds. In 2021, they're expecting a $161 billion deficit. That obviously sounds terrible, but it's actually $52 billion better off than what they predicted in their mid-year economic statement. They expected that a forecast drop to $57 billion by 2024, and that debt level is expected to peak at $980 billion in 24-25, almost $1 trillion worth of debt, which they tell us is manageable under the current interest rate environment. So who are the winners and who are the losers out of this? So the winners, we have women, which has been a large target in terms of the Morrison government, childcare, aged care and taxpayers, and we'll cover it off on each of those. We have the losers, which are the international tourism. Obviously the outbound tourism would normally cost Australia $55 billion in spent money, and also the inbound tourism isn't happening because of the COVID restrictions on international travel, and that's affecting the internal tourism industry. Climate and renewables. There's no direct funding in the budget for renewables except for a $30 million over the next year for a big battery project between Katherine and Darwin, and most of the government spending on energy is focused on low emission technologies. Universities have obviously been doing it tough, both in terms of students that are coming from overseas and their cash flow, that system with them, and then also the future generations, the ones that are going to have to afford to pay for this deficit and this spending. Let's have a look at what business is expected to do over the next 4 years. And just keep in mind this budget has a 4-year time frame, so most of the numbers you'll see here will be spent over 4 years. So they're funding 170,000 new apprenticeships and traineeships, 163,000 new training places to help workers upskill. They are putting an extension on the temporary full expensing, which used to be the instant asset write-off, out to June 2023. There's $1.2 billion investment in the digital economy strategy, which has obviously become in focus through COVID-19 and the online market that we've seen happening. Small brewers and distillers, a big winner. There's a full remission of any of their excise levy up to $350,000. The AAT, or the Administrative Appeals Tribunal, has been given greater powers to pause and modify the ATO's debt recovery against SMEs, and we're starting to see the ATO taking a more aggressive approach in terms of tax debt recovery. Now we've gone through the initial phase of COVID-19. And the mandatory employee superannuation contributions, or SGC, is increasing from 9.5% to 10% on the 1st of July 2021. If we just hop back to the extension of the temporary full expensing, it's really about businesses investing in new plant and equipment and new manufacturing, they are able to, and again there are 3 levels to this, if the business is under $5 billion in turnover, and that's 90% of the businesses in Australia, you can write off any new depreciating asset for business. If you are $50 billion or higher, you can only write off new equipment, not second-hand. And if you are under $10 million in turnover, you can write off the small budget pool, the small business pool, which is the balance of your written down value of your plant and equipment each year. So although it's stepped, it is a definite pointer to the government wanting business to step up and assist in the growth of the GDP. Up till now, most of our GDP growth has been by personal spending. We've seen that happening with renovations, car sales, etc., where they have excess cash because they haven't been going overseas and going on long holidays. That money is now being redeployed into buying assets and redeveloping the houses. So they think that'll tailor off on 2023, and businesses are expected to pick up the slack from 23 onwards. Regions and infrastructure, again, another building projects. There's $15.2 billion been added to the government's announcement last year of a 10-year, $110 billion program. So over $2 billion of that's been allocated to Queensland projects, including our terrible Bruce Highway, $400 million for that, $178 there for the Gold Coast rail line, and also $126 for the Gold Coast Light Rail. And then a number of projects, including right down the bottom, you'll see their local roads and community infrastructure projects, where I think ScoMo's come out and said it's a use it or lose it policy for shovel-ready projects. So they've got to have something ready to go, and then you'll spend the money. Individuals and families, the very basics of the government, the tax take, the tax reminder of what our tax system looks like. We have a progressive scale of taxation from 0% when you're under 18,200 all the way through to 45% when you're 180,000 or above. And don't forget you needed to add Medicare levy onto those rates as well. Now, currently there is this thing called the Low and Middle Income Tax Offset, or LIMTO, as we call it in the biz, and that has now been extended through to 30th of June 2022. So what effect does that have? Currently, the tax offset looks like this. You can see there right in the middle is the sweet spot between $48,000 and $90,000. You get the full $1,080 tax offset. Anywhere either side of that there's a sliding scale. So if you're under $37,000 you'll get nothing, or up to $255, and if you're above $126,000 in income you don't get any of the offset at all. Now this is quite a costly investment by the federal government. It's going to cost us $7.2 billion over the next 12 months. But again, it's about keeping money in the pockets of the mums and dads, and hopefully they're spending that on Australian product. Will it be withdrawn from 30 June 22? We probably think so. If the economy is going well, businesses investing in that plant and equipment, then there'll be less pressure on the individuals to spend, and effectively there'll be a $1,080 tax increase from 1st of July 2022. Jobs and employment, a centrepiece of the budget. As I said before, they're targeting a minus or a sub 5% unemployment rate, 4.75. There is a significant cost attached to that, which is the increased debt they have for these projects, and obviously that adds to the deficit bill that we've got at the end of the day. There's going to be a major overhaul of the $4 billion Job Maker hiring credit program, which has been largely ineffective up till date. And they will be continuing the $50 fortnightly increase in the Job Seeker increase, which happened during COVID-19. And that'll cost us almost $9 billion over the next 4 years. So you can understand why they're trying to get people off unemployment. Family Home Guarantee. This is a specifically targeted one at single parents with dependent children over 4 years old who have household income between $80,000 and $125,000. The government will guarantee the deposit between the 2% that they have to come up with and the 18% to make a 20% deposit most banks require. And the program will support up to 10,000 single parents. Now 80% of those single parents are women and will most likely take up the majority of those 10,000 support programs. I guess you need to question whether they're putting them into a level of debt they can't afford, or whether they're actually putting them into a situation where they've got an asset that'll increase in value that's going to remain affordable. Time will tell. They're extending the new home guarantee for a second year. There's an extra 10,000 places for first home buyers to build or buy a newly built home with a minimum of just a 5% deposit. And again, I remind you, most banks have in the past wanted somewhere like a 20% deposit. Increasing the maximum amount people can withdraw from superannuation. So they had a scheme where you could actually contribute to your superannuation scheme and withdraw that amount out of your super once you bought your first home. That amount has been increased from $30,000 to $50,000 to put towards a new home purchase. And then there's also the Home Builder program, which has given a lot of rise to the additional work that's happening in the renovation space. It gives people who have already applied an extra 12 months to start their build. So now it's an 18-month period. That's $774 million over 2 years for new applications. And a lot of those renovations have been delayed either to inability to get builders, inability to acquire product. It's been a very busy market for our building construction clients. Childcare, again, another centrepiece in this budget. They've added a $1.7 billion to an already $10 billion budget for childcare support, and that'll be effective from July next year. It increases the childcare subsidy to a maximum of 95% for the second and subsequent children in care, so very much reducing the cost to the parents to only 5%. And most benefit will be with families with 2 or more children under 5 years, and it does actually remove a $10,560 annual subsidy cap for those families with incomes over $189,000, so they will become uncapped. So what have they done for women's health? There's $354 million to support women's health, maternal and baby health measures, including improvements to cervical and breast cancer screening, extra mental health support for new and expecting parents, and funding for endometriosis programs. Women's security, there's $1.1 billion for domestic violence, both in prevention and victim support, including access to cash in those ladies in those situations. And the current $450 minimum per month that you have to have in wages to get SGC or have your employer pay SGC will be abolished from the 1st of July 2022. Now, given the vast majority of part-time workers in the workforce at the moment are female, that $450 will increase the amount of superannuation going into their retirement funds. But of course, that's got to be funded by the employers. So your super and retirement. So those of you lucky enough to be in that retirement session, we just remind you what happens in terms of contributions to superannuation. There are 2 types. One is the concessional, where you get a tax deduction, and one where is the non-concessional, which you don't get a tax deduction and happens in post-tax dollars. Currently, the concessional cap, or the tax deductible cap, is $25,000, and that can come from you personally or your employer. It includes obviously the SGC, currently at 9.5% superannuation guarantee charge. That'll increase by 10% to $27,500 from the 1st of July 2021. And the non-concessional cap is currently $100,000. That'll increase to $110,000. And if you are able to bring forward 3 years, and there are some age limits involved in that, you can bring forward up to 3 years of those non-concessional contributions, which would make it $330,000, but you have to overlay the total superannuation balance you have at the moment. And if once you exceed the $1.7 million in super, you can get no further contributions of non-concessional into your superannuation fund. It'll only be growth on earnings. Downsides of contributions. This was aimed at getting people, older people, out of their houses, large houses that they're keeping, because there's a fair amount of money involved in it. Enable them to get some of the proceeds in the sale of their house into superannuation, so they can have up to $300,000 per person, so $600,000 per couple can go into superannuation from the sale of a house, and they've reduced the age limit to 60 from the 1st of July 2022. So if you're selling your principal place of residence, you've been in for longer than 10 years, you can get up to $600,000 of those proceeds into superannuation. They've also removed the voluntary superannuation work test for those aged between 67 and 74. In the past, you had to be able to show that you worked 40 hours in a continuous 30-day period. That's been removed as of the 1st of July 2022, and you can make your contributions without having to show that you can meet that work test. Those of you who are currently in pension phase within your superannuation environment will know that there is a minimum drawdown that you have to have out of your superannuation funds. That minimum drawdown is intended to increase as you get older, so it's such a fact that you reduce your superannuation balance to nil by the time you depart this earthly demise. So the minimum draw had been halved in the current year. That'll go back to the normal minimum draw starting at 4% through to 14% of your closing balance of your superannuation fund from the prior year you have to take as a minimum drawdown and use those proceeds. Aged care. Again, another big part of the Morrison government and some of the issues that they've had to deal with, including a Royal Commission into the neglect within the system. Their answer to that is a $10 billion funding program over 4 years. It's estimated there are 200,000 Australians living in aged care facilities. Part of this funding will include an $80,000 home care package aimed at helping support elderly people to stay at home and providing additional resources and staffing for those in aged care facilities. And as we always, we like to find a little something in the budget papers that you might find interesting. Our National Archives, which are based in Canberra, which do a wonderful job in keeping and recording our history, have requested $67.7 million to save the most urgent and at-risk material as it decays. And some of those are speeches from our wartime Prime Minister John Curtin. The government saw it only fair to allocate them $700,000. So they're about $67 million underfunded in terms of what they would like.
Well, there you have it. That's the federal budget for 2022, and it's been done and run. We hope you found some value in the presentation we've done this morning, and should you have any specific questions, please don't hesitate to email us at email@peakpartnership.com.au. If you'd like a more in-depth analysis of the issues we've discussed here on the budget, please head to our webpage, which is www.peakpartnership.com.au and /budget. Thanks for your time and watching us, and don't forget, stay healthy, be wealthy and become wise. We'll talk to you all soon. Bye.